Hello, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, certainly lots going on in the markets this past week. Today's agenda will include some looking at upcoming public appearances, so we'll start off with that. For those of you who happen to be listening in Southeast Asia, I will be on Singapore CNA TV, this Thursday at 6:45 a.m. Singapore time, which actually, now that I think about it, this is actually going to be Friday morning because it's 6:45 p.m. Thursday night for me. So it's actually Friday the 31st at 6:45 in the morning. I will be on Singapore CNA TV being interviewed about the markets. In less than 2 weeks, about a week and a half or so, I will be in hopefully sunny Florida at the Orlando Money Show. I will be speaking on Saturday, February 8th at 8 a.m. in, well, clearly the morning. The link for information about that, and again, for those of you who don't know, the Money Show are free conferences to the public. It's a 3-day show. The Orlando Money Show is one of the biggest ones in the country. They do a Las Vegas one coming up in later this spring too. There's a New York Traders Expo in March. These are all part of the umbrella of the Money Show. These are free conferences. So go to intheknowtrader.orlandomoneyshow.com. You'll get more information about Orlando's Money Show, dates, speaking schedules for everybody, how to sign up for it. And also on that website, you will find out about all the other money shows and traders expos in the country for the balance of the year. They are very good at hitting major cities throughout the country. So there's one in Chicago, there's Seattle, there's Philadelphia, New York, Florida, Texas, etc. So these are great shows to learn a lot about markets from all different types of speakers. I think the Orlando Money Show probably has something in the neighborhoods of 75 different speakers from the industry talking markets and strategies and how to do things and their thoughts, etc. So I will tell you that I think it really pays to take advantage of getting to one or more of these shows each year and learning from some people who probably have some better ideas on how to do things in the marketplace to make for more profitable trading. As far as the rest of today's agenda, we're going to take a look at the S&P. I'll also just quickly touch upon gold, just because of some things I see on the charts. And then, given how much has gone on in the markets in the last week or so since peaking and pulling back, and even though as we speak, the S&P is up 33 points as we record this late morning on Tuesday. So this has gotten back a good chunk of yesterday's decline, but I will tell you my thoughts on what I expect coming up. And then we're going to look at the 11 S&P macro sectors because, look, combined, they make up the S&P. It's interesting always to see how each one of the sectors is doing, which ones are technically strong, which ones are weak, and often a good way how to position those spider ETFs in your portfolio, as well as which ones not to include at all, which actually leads me to just kind of giving you a little tease on a new newsletter that In the Know Trader is going to be coming out with later in the quarter. It will analyze the 11 sectors. It will be a monthly newsletter, and it will tell you which 7 of the 11 S&P sectors to be in at any given time. If you can avoid the underperformers, you can handily outperform the S&P. So our goal is going to be to tell you which 7 sectors to be in. They're all very liquid spider ETFs, and the goal in this is going to be to avoid the 4 worst laggards in the marketplace. And if we do that as well as we do other things in the market, then you're going to do better than the market as a whole. And of course, with commission-free trading these days, you have no cost to get in and out of the spiders, in the sense there's no commission anymore. And again, these are super liquid. So we think this is going to be a very important and new product to the marketplace that helps you compete. So think of a traditional mutual fund that is benchmarked to the S&P. So their performance is going to be judged at the end of the year, how they did versus the S&P, and their goal always, these guys are what we call in the industry long onlys. They have all their money invested in the market at all the time, except for perhaps a couple of percent available for redemptions. And their goal always is to figure out which of the sectors to be in, which to overweight, which to underweight. Our take on that is simply be in the sectors that aren't doing the worst, and you're going to do very well. So that's a brand new newsletter coming out later this quarter. I will give you more information about it as it comes closer to launch date, and we'll get you set up for that. So in order to contact me, Rick at inthenotrader.com. Our website, inthenotrader.com, has a lot of information about what we do, of course, who I am and my background on the street. I am in my 40th year on Wall Street. As many of you know, I was formerly Morgan Stanley's chief market strategist for many years. I was a commodities pit trader for a dozen years before I even got to Morgan Stanley. Head of cross-asset trading at Wells Fargo, the designer of Bloomberg's whole charting system, and head of futures, commodities, and technical analysis at Bloomberg for 3 years. So I speak from experience. I speak from trading knowledge, buy-side and sell-side experience throughout this 40-year career. And you'll see lots of videos and information on our website, including how to sign up to be an InTheKnow client to get our weekly newsletter that talks about the S&P, how to position it, as well as every week recommends a new ETF to trade. It's pure ETFs that we do in the InTheKnow Traders Tactical Trader Report. And again, we'll be adding a new report later this quarter on the sectors. Okay, let's take a look at some charts. We're not going to do this week the S&P relative performance like we look at most weeks, simply because we're going to look at the S&P and then all 11 sectors this week. Let's start off by looking at the S&P itself. We're going to look at two charts, both the daily and the weekly. And actually, I'm going to flip this, and let's start off with the weekly chart. So you can see the clear channel line that we've been trading in since, let's just say, the Christmas 2018 bottom. And so I've drawn an uptrend line from that and a parallel line against it, which of course hit many of the highs in the first quarter and second quarter of 2019. But most importantly are two things on this chart that really stand out for me, and why, if you're a client, you knew how important to us 3,336 is in the S&P, full exhaustion level that's been in place since essentially June 1st of last year. So when we made this bottom, these models suggested that if we broke above 2881, we would get to 3032, and then breaking through that would get ultimately to 3,336. You guys know that last week the S&P made a high at 3,337 and change, a point and change above that level. Interestingly and importantly is that it also last week marked an aggressive time to mark combo 13 signal, suggesting exhaustion of trend. That is unrelated to this target of 3336. So one is a timing model and one is a measurement model based on physics in the market. The fact that I get an upside exhaustion signal at the same time that we hit a significant target that had been in place for over 6 months was enough to have me tell clients to reduce long exposure, not to be buying stocks within the uptrend. Look for a decline. If we look at the other previous 2 times that same 13 signal showed up, you can see how effective it was. It came in late April last year, just before the market had a significant decline. It also showed up in, looks like, August of 2018, before a much more significant drop into the fall and early winter. That was the major decline last, well, now it's just over a year ago. Now, do all these signals always work exactly? No. Here, let's put a rectangle around this just so you can see. Here is an upside exhaustion signal. That was too early. We still went about 6 weeks higher before the market pulled back, so they're not always going to be exactly as good as we've seen the last few, but nonetheless, that signal showing up at the same time that we hit this 3,336 target got me quite defensive, and I announced to both institutional clients and in the know trader clients that I was the least bullish I had been and since the run up that essentially started here in October. Now, the coronavirus coming when it did, obviously these models can't anticipate exogenous events. It happened to come when it came. Now, do I think the market would have paused and pulled back from where this 3,336 level anyway? I do. Is the coronavirus an extra kicker that certainly potentially adds more downside oomph to the move? Yeah, sure. And here's now the daily chart. The daily chart also had a sequential 13 signal last week, along with a setup 9 count. In a rip-roaring bull market, we'll see lots of these, and they mean less on a daily chart than they would on a weekly chart. The fact that the weekly and the daily both happened at the same time last week gave more credence to the fact that we could pull back, and the daily chart had the same 3,336 target that the weekly one did. That's why we're looking for a decline. Now, yesterday's low, 33.24. My downside target on this is 3,225. So we didn't quite get there, and we're bouncing strongly today. We're on the highs of the day as we do this. Do I think the market simply turns around, blows through these highs as if they don't mean anything? I don't. I actually think we're still, even if we play with these highs, even if we exceed the highs, I don't think we exceed by more than 1 to 2% max before the market pulls back again. I think the coronavirus is I'm not a doctor, but I think it's something that the world is going to be dealing with for some time. And I think this is something that is not just, how do I say this? Just it's not going to go away quickly. And the fact that the S&P is up 34 today is certainly good news. But I suspect you're going to want to be selling into this rally, that this is not a 1 or 2 day sell off, and that everything is still honky dory, and we just keep going up the way we have since October. So I'm going to use any strength we see now to lighten up some long exposure. I still think we're at a very tentative place in the market. And you do not need to be continuously buying into the market all the time. And there are certainly times and places when that is not called for, even within a strong uptrend, and one that I think at some point this year, the market gets my minimum upside target for the S&P this year is 3,477, 3,477. So in round numbers, that's 140 points above what this high was that we saw last week. So I do think we'll get there at some point this year. I don't think we just go and get there now. So I'm apt to be a seller on strength here and look for further moves down. Where can the market go on the downside if this takes another decent leg down? And I'm going to go back to the weekly chart on this and tell you that 3,189, this level right here with this little dash line, is an important level to me. It's kind of my hedge, it's my bigger hedge level. In other words, if we properly break this line, and actually, let me take candles off because I see sometimes this is not printing candles correctly. So we're on the high of the week, and it was showing that we were not. This level here, 31.89, is going to be my trigger point. If we properly break this level, then I think the door opens for a larger decline. So if we break 31.89, I hedge up more of my long book. However, 31.89 might very well end up becoming a more important bounce point if we get down there. It all depends on how we approach it. That's going to depend upon whether or not we're more apt to be a buyer or a seller of. Buyer would be more tactical buying within an uptrend. Selling would be that we think there's a more substantial top in place. So when and if we get down here, I'll probably be talking about it on this show. My clients, of course, will get this information far more quickly. And of course, with the way the markets move these days, you can see even one day can make the difference between being in the right place and the wrong place. So that's my thoughts on the S&P right now, is that I'm still concerned. I still think 33, 36 is meaningful, and I don't buy into the fact that the market is flying the way it is right now, as if there are no ramifications from this virus. So before we get to the 11 sectors, let me just show you gold quickly, because a couple of things on the gold chart that stood out to me. In the bigger picture, I've got $1,700 or so as a more significant upside target in gold, basis this 6-year rounded bottom that broke out from anywhere of these. Pick whichever one of these lines in here you want to say was the breakout. I typically say 1375 or so was the breakout area off of approximately an 1,050 low. So that's the $325 height to this entire rounding pattern, and 325 onto 1375, and that target's up here at 1,700. So I think gold is going to a minimum of $1,700 off of the bigger move, and potentially much higher over time. But let's look shorter term. That's the big picture. Let's take a look at a daily chart. And you'll notice that yesterday has a sequential sell signal. So to me, no surprise that gold is off today. Now the dollar is also up today, as it's been virtually every trading day of the year. And the Street got this wrong again, as they so often do. Consensus all was that the dollar was going to sell off to start the year, and for much of 2020 so far, that has been incorrect. The dollar's been up almost every day in January. And yet gold's been able, interestingly, gold's been able to rally much of the month. So this spike high here was the evening that Iran bombed the military base in Iraq. It was a spike high, sold off, still kind of held out above and into support. We've turned around, moved up for the last week and a half, but now again we face this potential upside exhaustion signal, at least on a near-term basis, and that's why you're seeing, I think, gold find some sellers right now. So it's a combination of continued dollar strength, the S&P coming back today, and the fact that you've got this signal here for upside exhaustion. And you'll see there was one here. Now, just I've mentioned this before in other times, but I'll mention it again today. If a market's been moving higher, as gold was since May of last year, and you get a 13 signal, and even let's not miss this one here. Here it went sideways for a week and a half. Here it went sideways for, I'll say, 2 months. Those are effective signals, because if a market is trending higher and then it stops trending higher, that's a change in trend, because you have to remember there are three trends in the market: up, down, and sideways. Sideways, going sideways after you've moved higher is a change in trend. And so you don't have to see a market move straight down for these signals to be effective, because what the signal is there is to tell you when not to be a buyer in an uptrend, or if these came on the downside. So let's say we're selling off, and let's say there was a 13 underneath the price action, just where I have my cursor here. I would tell you in a downtrend, bad time to be a seller. So what this is telling us now is that essentially within the uptrend, this is a bad time to be a buyer. Now, you've got the spike high. You've got now the chance for a near-term high. And what this would say to me is if you get a few closes, probably above 1595, then you can come back and get into gold again. But until that happens, or it sells down to support, there's nothing to do right now in here. So, you know, again, in the big picture, yep, I think gold's going higher. And, you know, you've got this move here. You can even look at this as, if you look at this as a base, and the breakout from the base occurred here. So if this is wave one, here's two, here's three, here's four, we're in wave five. We can measure in wave one's height. So let's do this quickly, and then we'll get to the sectors. So here's the height added on. So wave five could go 1628 to, let's say, 1741. Anything in there is a perfectly normal height to wave five. And notice that that encompasses our $1,700 target. So, you know, we could still see gold move higher and still approximately get into this somewhere on, let's say, $50 either side of 1,700, and still be an acceptable place that we could see a pullback from. But the big picture to me says gold is going higher over time. So I'm still a fan of gold. We're long gold stocks right now. Do great in that. I don't have a gold position on currently. I will look to get into one where I find a good risk reward, but I am long gold equities, and they are doing better than gold itself. So I'm content being long in that space. Now, let's get to the 11 sectors. Got about 6 minutes left, which is perfect. That's half a minute or so per sector. So here we go. We're going to go alphabetically through the 11 spider sectors. We're starting with XLB, the materials. Here's the all-time high back in early 2018. We've got a couple of 13s showing up that this 13 was good. This 13 has also been good. We've gone nowhere now for 2 months. This needs to break out above 61, what is it, 86 or so, a breakout there, then should lead to new highs, and what I would suspect us taking out the highs from 2018. Support on the downside, 57.66. Notice in the past, the propulsion levels, here they got exceeded, but the lines are still dashed. That means they never got broken properly. So pulling back to propulsion levels are significant. So first support here is 57.66. XLC, obviously limited price history because this just got put into place, the communication services sector. This is on all-time highs, but we really don't have proper reference point here to know where this would have been if it had been in place at the time. So I can't help much on this other than to tell you that if it continues higher, look for a target up at 60, just north of 60 and a half. This is already playing with potential support level. So both 55 and change and 53.40 are the two near-term places if you like that sector to get into. XLE, energy is continuously a disaster. Actually, I noticed that this morning, XLE divided by, let's see if I still have that chart up from last week, XLE divided by the S&P. By the way, this is just the total trading history of the XLE divided by the S&P 500, the SPY, since it started trading in 1998. And you can see barely, we have just tucked beneath, we are on all-time lows on a monthly chart of relative performance of energy. So it has been a dog. I went equal weight on this in the fall, so I'm I'd just be losing what that sector is losing relative to other ones, but I'm not overweight or underweight. I'm simply equal weight. But that's still essentially not working because it's just not getting anywhere versus the S&P. Okay. So this potential support on the XLE itself, 54.43. I think this probably has to get above 64 before you really get some type of breakout. Energy's in trouble. It is getting into some longer term support. Obviously, here you can see lows going back several years, but this has been the problem child within the S&P and essentially the worst place to be. XLF, financials. Well, higher interest rates help this sector. Lower interest rates do not. You can see back in 2018 what had been the all-time high, a 13 and a 9 combination. Now we've got a 13 in the fall, followed by a recent 9 setup count. It's gone nowhere for weeks. Look for support 29.03, bigger decline 27-ish. I don't think we go there unless rates really crumble, take out all-time lows. Otherwise, on the upside, look for resistance first at about 32 and then 34.5-ish. XLI, industrials, made a new all-time high, and yet they've pulled back recently. This is still one of the better sectors. Don't forget that transportation is in this part of the industrial, so Boeing is in this piece of the pie. And here on a pullback, I'd say 79.5-ish or so looks to support. We need to break out above this propulsion exhaustion level, 84.5, in order to the next target, 87.40. XLK, technology, last week, all-time highs. Minor pullback this week. We're actually only down a little bit on the week. First support 94.16, second support 89.49, and on the upside, this is still a valid target. Actually, both of these are. So 100.34 and 102.5 are upside targets. XLP staples, new all-time highs. Certainly a defensive sector. If this starts to fall back, look for 61.59 for support. Targets on the upside are about 65.5 and 65.5. XLRE, real estate. Also limited price history as this got a spin-off from the financial sector. Trying to break out to new all-time highs. Been a strong player. Recently, let's see, upside target 41.38, first support 39.44, second support 38.67. Notice we got a MACD crossover here, bullish one. I haven't seen that much elsewhere. XLU, right here against propulsion exhaustion level also. Utilities may come under a little pressure as interest rates have fallen back. This is, you're really playing the interest rate market here. When you play utilities. So right now, the marketplace likes this, but XLV, healthcare, all-time high last week, pulled back. Notice stopped right into first level support, 122. If we close higher this week relative to last week, and then next Friday close down underneath there, then I think it's going to 97.36. Otherwise, this looks decent. And lastly, XLY. Stalling, so consumer discretionary. These are going to get, obviously, discretionary names are going to have some trouble due to consumer spending basis, how big the virus, plays out. The 13s have more or less stalled any major advance. On the upside, next target is 130 and change. On the downside, 121, 122-ish, and then 115.33.